Welcome to the Deep Dive, the show where we take a pile of research, expert notes, and analysis and pull out the absolute highest leverage insights for you.
And today, we are really getting into the weeds of technical analysis. We're looking at the Ichimoku cloud.
Right, the Ichimoku Kinkohayo. But, and this is important, we're skipping the 101 level stuff. We're jumping straight into the deep end.
Our whole mission here is to move you past just knowing what the lines are and into sophisticated application. We want to show you how to use this thing as a future projecting tool, something that gives you a real edge.
That's the key, isn't it? Because anyone who's looked at this knows its nickname, the one-look equilibrium chart. The whole idea is that with a single glance, you're supposed to get everything. The trend, the momentum, support, resistance, and the big one, future momentum.
It is ambitious, but it works. Now, to get to the advanced stuff, we do have to do a quick review of the components, just so we're all on the same page.
Okay, but let's do it with a focus on why the numbers were chosen. I mean, the system is built around these core periods, 9, 26, and 52. What are those? Why not, 10, 20, 50?
That's a great question because it gets to the philosophy of the whole system. Those numbers come from the old Japanese trading calendar back when it was created.
Oh, interesting.
Yeah, so 9 periods was about a week and a half of trading, and 26 periods. That was roughly the number of trading days in a month. They're not random, they are anchors in time.
Anchors, I like that. So let's map those to the lines, the fastest, most sensitive one first.
That would be the Tenkan-sen, the conversion line. It's calculated over those 9 periods. It's all about short-term price velocity. Very quick to react.
And then we step back a bit for the main trend.
Exactly. That's the Kijun-sen, the baseline. It uses the 26-period look back. This is your foundation. It's slower, steadier. A cross between the Tenkan and the Kijun is the most basic signal in the whole system.
Okay, so now we get into the cloud itself, the Kumo. This is where we start looking into the future.
Right. The Kumo is formed by 2 lines, the Senkou spans. Senkou means leading.
Leading span, makes sense.
So Senkou span A is the average of the Tenkan and the Kijun. It's the balance point between that short-term and medium-term momentum. And here's the key. It's plotted 26 periods ahead.
That's our first step into the future.
It is. And the other boundary is Senkou span B. This one is calculated over the longest period, 52 periods, 2 months of data. It's also plotted 26 periods ahead.
So the cloud, the Kumo, is literally a projected zone of support and resistance.
That's it. Price above is bullish, price below is bearish. Simple as that on the surface.
And the final piece of the puzzle, the one that gives us a kind of sanity check.
The Chikou span, the lagging span. It's just the current closing price, but it's visually shifted back 26 periods into the past.
A retrospective view.
A critical one. It tells you if the trend today has real strength compared to where the market was a month ago.
Okay, let's unpack that. Let's jump into the first advanced strategy, which is reading the cloud itself. Most people just see if the price is above or below. But we need to look inside the Kumo.
Absolutely. The structure of the cloud, its shape is, well, it's almost prophetic. The number one thing to look at is its thickness.
Okay.
A thick cloud isn't just support or resistance.
Yeah.
It represents deeply entrenched market conviction. It means momentum has been strong and sustained. So if the price pulls back to a thick cloud, the odds are very high it will find strong support there.
But wait, if a cloud is already thick, doesn't that mean the trend is already well established? Aren't we a bit late to the party?
That's a fantastic point. A thick cloud makes reversals harder. It tells you to respect the current trend. But a thin cloud, well, that's your advance warning sign.
A warning sign of what?
Of weakening momentum. It means the short-term and long-term forces are converging. The system is losing its equilibrium. A thin cloud suggests that support or resistance is weak, and you should be much more cautious.
So even if the price is, say, above a thin cloud, you're saying there's risk there, potential for a breakdown.
Exactly. And this is where it gets really interesting for advanced users. We look for something called the Kumo twist.
The Kumo twist, that's when Senkou span A crosses Senkou span B.
Yes. That's the cloud flipping from bullish to bearish, or vice versa, projected 26 periods into the future. A thin cloud, combined with a projected twist, is probably the strongest warning sign in the entire system that the long-term trend is about to change.
Wow. So you're getting a heads up a month in advance, essentially.
You are. It's a signal to seriously manage your risk or prepare for a major shift.
Okay, so that's the future projection. Let's bring it back to the present with the Chikou span. As you said, the lagging span gets ignored. Why is a line plotted in the past so important?
Because it's pure confirmation. It isn't an average. It is the current closing price. By plotting it back 26 periods, You are asking a simple question.
Which is?
Is today's price powerful enough to clear the hurdles that existed a month ago?
It's like a momentum check against recent history.
Precisely. For a true confirmed bull trend, you don't just want the price above the Kumo. You need the Chikou span to be trading freely above the price action from 26 periods ago.
So what's the trap here? The divergence that catches people out.
The divergence is when the price is making new highs, maybe it just broke above the Kumo, but the Chikou span is lagging behind. It's stuck in a cluster of old prices.
So the current move doesn't have enough force to overcome the past.
You've got it. It's a sign the move lacks broad support. It's like buying a sports car that looks amazing, but you look under the hood and it has a tiny, weak engine.
That's a perfect analogy. The Chikou span is the engine, and without it, any breakout from the Kumo is suspicious at best.
Highly suspicious. You should treat it with extreme caution.
Okay, here's where it gets really strategic. Let's talk about putting it all together across different time frames, because fighting a weekly trend on an hourly chart is just a recipe for disaster.
This is where discipline becomes everything. Multi-timeframe analysis is how you anchor your short-term trades to the long-term market reality. It filters out so much noise.
So how do you set up that hierarchy? What is the dominant reality?
The higher time frame is always the boss. Always. You start with the daily or weekly chart to establish the market's bias. Is the price above a thick Kumo? Is the Chikou span clear? If the daily chart is screaming uptrend, then your job is simple.
You only look for buys.
You only look for long positions, period.
Okay, but what if the daily chart is bullish, but then you look at the 4-hour chart and you see a bearish crossover starting to form? Do you ignore it?
You don't ignore it, you use it. That bearish cross on the 4-hour chart within a strong daily uptrend is not a reversal signal, it's a pullback signal.
It's an opportunity.
It's a discounted entry opportunity. You use that lower time frame to see the price pull back to a strong support area, like the 4-hour Kumo. Then you wait for signs of a rebound before you enter. You're using short-term weakness to get a great entry into the long-term strength.
So higher time frame dictates what you trade. Lower time frame dictates when you trade.
You just summarized a professional trading strategy in one sentence. It stops you from swimming against the current.
All right, let's make this real. We have a case study of a trader, Sarah, who used all 3 of these advanced techniques on the USD-JPY pair. Walk us through it.
Okay, so Sarah starts with step 1, identify the dominant trend. She pulls up the daily chart for USD-JPY. She sees the price is way above the Kumo.
Bullish.
Very bullish. And she notes the Kumo is thick, meaning that support is strong. Tenkan is above Kijun, and the Chikou span is flying high, totally unobstructed. Her conclusion is simple, buy-only mode.
So she has her bias. She's just waiting for the right moment. What was step 2?
Step 2, refining the entry. She drops down to the 4-hour chart. The market's choppy, but she's patient. She waits for a pullback, specifically a dip back towards the top of the 4-hour Kumo. That thick cloud is her target zone for entry.
Okay, now for step 3, execution. How did she manage her risk? Where does the stop loss go?
This is key. She didn't just put her stop below the Kijun-sen. She placed her buy order just above the 4-hour Kumo, but her stop loss went below the entire cloud, below Senkou span B.
Why so wide?
Because she's respecting the Kumo as a zone. If the price managed to break through the entire cloud on the 4-hour chart, her whole bullish thesis would be in question, and she'd want to be out of the trade anyway. It's a logical, structural stop loss.
A very clean boundary. Okay, the trade triggers. Now for the hard part, step 4, monitoring and exit. How did she know when to take profits?
She used the Chikou span as her guide. As long as the Chikou was moving freely of the price, she stayed in. But then the rally started to stall, and she saw the Chikou span begin to flatten out. It was struggling to get past the historical price peak.
The engine was slowing down.
The engine was sputtering. That was her signal. The momentum wasn't there anymore. So she exited the trade, locking in her profits right before the price did, in fact, reverse and drop sharply.
A perfect example of using the system for a disciplined exit, not just an entry. So let's tie this all together. What does this deep dive mean for you, the person listening and trying to apply this?
It means that Ichimoku is so much more than a basic indicator. When you learn to read the Kumo's thickness, when you use the Chikou for confirmation, and when you layer on multi-timeframe analysis, you move from just being a chart watcher to a genuine analyst.
You're making decisions based on complete holistic view.
Yes. And before we finish, we have to include the critical risk warning.
Of course.
Trading financial instrument involves a significant risk of losing your capital. Market volatility is real, and you can lose more than your initial investment. This content is for educational purposes only. It is not financial advice.
An essential reminder. Okay, for our final provocative thought, we started this by talking about the numbers 9, 26, and 52.
Right. The system is designed for one-look equilibrium. I want you to think about that balance. The system is deliberately built to weigh the hyperfast reaction of the 9-period Tenkan-sen against the slow, steady foundation of the 52-period Senkou span B.
It's a constant tension between speed and stability.
It is. So the question to leave you with is, how can that inherent balance in the indicator inform your own trading psychology, your own balance between aggression and patience?
It's not just a tool for analyzing charts, but maybe a model for analyzing your own decision-making.
It's a system designed for balance in the face of chaos.